Hey, welcome to The Explainer. Today, we're going to tackle something that can feel, well, a little intimidating. The language of finance. But look, understanding it is absolutely essential these days, and we're going to show you exactly how to get your head around it.
You ever do that thing where you open up a financial news site and bam, you're just hit with this wall of jargon? You see things like PERs, ETFs, leverage, liquidity. I mean, it's enough to make your head spin, right? If that sounds familiar, trust me, you are not alone. But here's the thing. These aren't some secret codes or mysterious spells. They're just words. And in this explainer, we're going to break them down one by one. Our goal is to give you that fundamental vocabulary you need to feel confident and, part of the conversation. All right, so let's dive right in. And we're going to start with a really foundational concept, something that's at the very heart of how money moves and how things get valued. So, what is liquidity? It's actually super simple. It's just how easily you can turn something you own into cold, hard cash. For example, a stock in a huge company, that's very liquid. You can sell it in seconds. A piece of fine art, though, not so much. You've got to find just the right buyer, and that can take a long time. You'll also hear people talk about their portfolio, right? If they say, oh, 30% of my portfolio is in liquidity, all that means is that 30% is just sitting in cash. Okay, so now we get how easily we can trade stuff. The next logical question is, why would you trade them? This brings us to two big fundamental philosophies in the world of investing. And really, this all comes down to one simple question. Which way do you think the price is going to go? Up or down? Going long is what most of us think of as investing. You buy an asset, say a stock, because you expect its price to go up. Going short is the exact opposite. It's basically a bet that an asset's price is going to fall. It's definitely a riskier move, but it's a key strategy for investors who think something is just plain overvalued. And that leads us right into another key distinction, which is all about what kind of return you're looking for. Fixed income investments, like bonds, are pretty straightforward. You're basically loaning out your money in exchange for set, regular interest payments. They're stable, they're predictable. Variable income, on the other hand, comes from things like stocks, where you own a piece of the company. The returns are not guaranteed, they can be all over the place, but the potential for much bigger growth is there. You see, it's that classic age-old trade-off between risk and reward. Okay, so we've talked about the big ideas, the philosophies. Now let's get into the nitty-gritty. Let's get practical. How do investors actually decide what a company is worth? Well, there are a few key numbers they look at. And the first, probably the most common metric you'll see, is market capitalization. You almost always hear it called market cap for short. Think of it as the big picture price tag. It tells you what the entire market thinks a company is worth, like right this second. And the calculation couldn't be easier. You just take the price of one share and multiply it by the total number of shares that exist. But of course, a company's size is just one piece of the puzzle. We also need to know if it's actually making any money, and that's where earnings per share, or EPS, comes in. This number tells you exactly how much profit the company is making for every single share of its stock. And don't worry, the math here is not complicated at all. You just find the company's total profit for the year, you find the total number of shares, and you divide one by the other. Simple as that. It gives you a really clear snapshot of its profitability on a per-share level. All right, this next one is super important because it actually connects the last two things we just talked about, price and profit. It's the price-to-earnings ratio, or PER. This is one of the most widely used metrics out there, and for good reason. So you see a stock has a PER of, say, 25. What does that actually mean? It means that the price of one share is 25 times its annual earnings per share. You'll often hear investors say the stock is trading at a multiple of 25. So let me put it in another way. That PER of 25 means that if the company's profit stayed exactly the same, it would take 25 years to earn back what you paid for that single share. Now, here's the critical part. A high or low PER isn't automatically good or bad. It's all about context. A super high PER on a fast-growing tech company might mean investors are betting on huge growth in the future. But that same number on a stable, slow-growing utility company, that might be a red flag.
So it's all about price versus earnings, with a heavy dose of future expectations mixed in. All right, so we've got concepts, we've got metrics, but how do you actually do it? What are the actual tools you use to invest? Well, let's get into the investor's toolkit. I mean, you seriously can't turn on the financial news without hearing about an index. Think of an index as a report card for a specific slice of the market. The S&P 500, for instance, tracks 500 of the biggest companies in the US. It gives you a really quick, at-a-glance idea of how the overall American market is doing. Okay, so how do you actually invest in, all 500 of those companies at once? Well, one of the most popular ways is with a mutual fund. It's pretty simple. It's a giant pool of money collected from thousands of investors, and it's all handed over to a professional manager who invests it for you across a whole bunch of different assets. It's a great way to get instant diversification. Then we have the ETF, which stands for Exchange Traded Fund, and it's kind of like a hybrid. Just like a mutual fund, it's a basket that holds lots of different assets, but, and this is the key difference, you buy and sell it on a stock exchange throughout the day, exactly like you would a share of Apple or any other single company. So when you boil it all down, the biggest difference between the two is really how and when you can buy or sell them. With a mutual fund, your order is usually processed once a day after the market closes. But with an ETF, because it trades like a stock, you can buy or sell it any second the market is open. It just gives you a lot more flexibility. All right, we are in the home stretch. We've covered all the core building blocks. So for this last section, let's just take a quick peek at a couple of more advanced tools and tactics that you're definitely going to come across. Okay, the word leverage might sound really complex, like some Wall Street wizardry, but I guarantee you're already familiar with the concept. It just means using borrowed money to make an investment. The best, most common example, getting a mortgage to buy a house. You're using the bank's money to control a big asset, hoping it grows in value faster than the interest you're paying. And to see how it's actually measured, let's stick with that mortgage example. If you buy a $100,000 house and you get a loan for $80,000, you are 80% leveraged. The whole point is to control a large, valuable asset using a smaller amount of your own money, which, it magnifies your potential gains, but, and this is a big but, it also magnifies your potential risk. Next up, another word you'll hear thrown around, derivatives. The key is right there in the name. Its value is derived from something else, some other underlying asset. So instead of buying and storing a bunch of oil barrels, for example, you could just buy a derivative contract whose price simply moves up and down with the price of oil. They're used for really complex strategies, like betting on price moves or protecting against risk. And finally, let's talk about how people actually decide what to invest in. Broadly speaking, it boils down to two major schools of thought. Technical analysis is all about studying charts and market psychology, and looks for patterns to predict what prices might do next. Fundamental analysis, on the other hand, is like being a detective. It digs deep into a company's financial health, its management, its industry, all to figure out its true intrinsic value. One looks at the what, the other tries to figure out the why. And that's it. From liquidity all the way to analysis, you now have the essential building blocks. These aren't just a bunch of random definitions. They're the tools you need to really understand and engage with what's happening in the world of finance. See? You're not on the outside looking in anymore. You have the vocabulary. The language of finance, it isn't about knowing all the answers. It's about knowing the right questions to ask. So what's your first one going to be? Thanks for sticking with us on The Explainer.